Good afternoon. My name is Paul Gore, Director of Community Development for the Asian Chamber of Commerce, Houston. Welcome to our ACC Learning, April 15, 2020. The Asian Chamber has been monitoring the COVID-19 situation since January, affecting our Asian business here in Houston, and happy to put together a wonderful webinar with one of our ACC members, Justin Lim from BDO, which is one of the major accounting firms here in Houston, to talk about and discuss the CARES Act in regards to tax benefits and implications that could help save money for your company. What a better way to talk about this during Tax Day, April 15th. We are an organization celebrating 30 years helping the Asian business community to foster economic trade among our members, and this is a crucial topic about resources that could help your business stay afloat during this uncertain and trying times. But before we continue the webinar, I'd like to provide housekeeping items. We'll be having a question and answer session at the end of the presentation. You can ask questions through the Q&A button on the control panel located on the lower portion of your screen. If you have any questions during the middle of the webinar, please submit your questions there. We'll try to answer all the questions asked, but please forgive us if we're unable to answer the question because of time constraint. Just want to let you know ahead of time. The PowerPoint and presentation will also be made available on our website at the end of the webinar. So please stay engaged and don't worry about taking notes. We'll make sure that you're able to be focused, and we'll have a lot of information that will be covered during the short amount of time. So in continuing with this webinar, I'm going to pass the mic to your presenter, Justin Lim, Tax Managing Director with BDO. Justin?
Hey, Paul. Thank you for the introduction and the opportunity to speak in front of the Asian Chamber today. I'm about to share my screen, and hopefully my slide deck just showed up. So today we're going to be talking about the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act, and with specific regard to the tax benefits and implications. I'm sure you guys have had enough about the SBA loans, the PPP program, as well as the EIDL loans. So today we're going to focus on tax benefits that were passed as part of the CARES Act. As Paul said, my name is Justin Lim. I'm a tax managing director with BDO. I've been with the firm about 8 years, focusing on private client services, which serves high net worth individuals, family businesses, trust and estate planning in the real estate, energy, retail, and restaurant industries. So today on the agenda, we're going to be talking about the CARES Act, the tax benefits and implications with respect to individuals, employer payroll taxes, corporate tax, a special rule that was placed in there for qualified improvement property, the impacts on partnerships, as well as other tax compliance and reporting issues. With that, we'll dive into the individual tax pieces of the CARES Act. So as part of the CARES Act, they passed a recovery rebate for individuals where an eligible individual will receive a refundable tax credit against their 2020 taxable income equal to $1,200 or $2,400 for joint filers, plus $500 per qualifying child. That credit phases out for individuals that have AGI exceeding $75,000. and for joint filers that have AGI exceeding $150,000. The credit will be automatically advanced to eligible individuals based on individuals' most recent income tax filing, which would either be the 2018 or 2019 tax returns that are already on file with the IRS. I've received notice from some of my clients that they are getting their advanced checks direct deposited into their account today, and that's the advanced checks that are being direct deposited are if you have filed a return with direct deposit information previously, and if you qualified using your 2018 or 2019 tax returns. Individuals that haven't filed their tax return for 2018 or 2019 may still be eligible to receive an automatic advance based on Social Security benefit statements. The next item I'd like to cover are some special rules for uses of retirement funds. Under the CARES Act, the IRS has waived the 10% early withdrawal penalty for distributions up to $100,000 from qualifying retirement plans for coronavirus-related purposes during 2020. The income from those distributions can be included in income ratably over 3 years, and taxpayers may recontribute those funds to an eligible retirement plan within three years without regard to the caps on contributions for those years. A coronavirus-related distribution is one that's made to an individual who is diagnosed with COVID-19, whose spouse or dependent is diagnosed with COVID-19, or has experienced adverse financial consequences as a result of the outbreak. And this includes businesses that have closed or reduced hours related to the COVID-19 shutdowns. In addition to the waiver of the early withdrawal penalty for the $100,000 of qualifying distributions, they've provided some flexibility for participant plan loans for coronavirus-related relief. The next change also relates to retirement plans. The CARES Act has waived the required minimum distribution rules for certain defined contribution plans and IRAs for calendar year 2020. It provides relief to individuals who would otherwise be required to withdraw funds from the retirement accounts during the economic slowdown. Generally, required minimum distributions begin at age 72 for those born after July 1st of 1949, or at age 70 and a half for individuals born before July 1st, 1949. Next couple of rules relate to charitable contributions. The first one under the CARES Act is that eligible individuals may take a qualified charitable contribution deduction up to $300 against their AGI in 2020. An eligible individual for this deduction is one that does not elect to itemize deductions and has made a cash gift to a qualifying organization. The next rule relates to those that itemize deductions. The CARES Act temporarily suspends the AGI limit, which is usually 60% of AGI for cash charitable contributions, and permits individuals to take a charitable deduction equal to their qualifying cash contribution made in 2020 to the extent that it does not exceed the excess of an individual's contribution base over all the other amounts allowed as a charitable contribution. If your charitable contributions are disallowed in 2020, they are carried forward for 5 years. The next item that we're going to start talking about are employer payroll taxes and the different credits and provisions within the that help relieve employers and businesses' payroll tax concerns and needs. So under the CARES Act, an employee retention credit is available for employers subject to closure during COVID-19. It's a refundable payroll tax credit for employers who are harmed by COVID-19 but retain their employees. The credit's equal to 50% of qualifying wages paid between March 12th and December 31st of 2020. The qualifying wages are capped at $10,000 per employee, and the maximum credit available is $5,000 per employee. You qualify for this credit if your operations were fully or partially suspended due to the COVID-19 related shutdown, or your gross receipts for the quarter were less than 50% of the gross receipts for the same quarter in the prior year. There is a threshold here at 100 employees for which wages qualify. For employers with over 100 employees, the wages that qualify are only wages paid to employees who are not working. And then employers with 100 or fewer employees would receive a credit for all wages paid to employees. In addition to that, the sick pay and FMLA wage paid as a result of the Families First Coronavirus Response Act are excluded from this calculation to prevent double dipping from similar tax credits offered under the Families First Coronavirus Response Act. And another item that makes you ineligible for this credit would be if you received a loan from the SBA under the CARES Act. The next item I would like to talk about is the deferral of employer payroll taxes. It permits employers to defer their payment of employer portion of Social Security tax, which is 6.2%, that would be otherwise due and payable throughout the year, ending December 31st, 2020. Employers that take advantage of this deferral would be required to pay 50% of the deferred amount on or before December 31st, 2021, and any remaining amount unpaid would be payable before December 31st, 2022. During the deferral period, employers are treated as having made timely deposits as long as payments are made when due under the schedule above, which would be 50% on December 31st, 2021, and 50% on December 31st, 2022. Self-employed individuals are also eligible to defer 50% of self-employment Social Security tax payments. One item that makes you ineligible for this provision is if you have small business loan debt forgiveness under the PPP program. Please note that this deferral of employer payroll taxes is only for the Social Security tax portion and does not include the Medicare portion. The next item I'd like to cover is the Families First Coronavirus Response Act credits and mandatory paid leave programs that were implemented. On March 18th, the President signed this act into law and made 2 mandatory paid leave programs with 100% government reimbursement via payroll tax credits, effective for wages paid between April 1st, 2020 through December 31st, 2020. The first part of this program is emergency paid sick leave, which provides employees up to 80 hours at 2 different pay scales, depending on whether you were having COVID-19 self-care or you had to care for others. The next part of this program expanded the FMLA rules, which provides 12 weeks of protected leave to care for children that have school closure or daycare closures. 10 of these weeks are paid at a rate of 2/3 of regular wages, up to $200 per day. Next, we'll cover some corporate tax provisions. The first item I'd like to cover is the AMT credit. Under the Tax Cuts and Jobs Act that was passed December 31st or December 22nd of 2017, corporate AMT credits were going to be refundable over a 4-year period for tax years beginning in 2018 through 2021. Under the CARES Act, any remaining corporate AMT credit not already refunded became fully refundable beginning in tax year 2019. Alternatively, taxpayers can elect to make the credit fully refundable starting in tax year 2018. The next item I'd like to cover are net operating loss rules. This is a pretty big change under the CARES Act. Under the CARES Act, net operating losses generated between December 31st, taxable years beginning after December 31st, 2017 and before January 1st, 2021 are eligible for a 5-year carryback. This is allowing taxpayers to take losses generated in tax year 2018, 2019, and 2020 and carry those losses back into previous tax years where they may have previously paid tax and receive refunds for those previous taxes paid. So NOLs generated in taxable years beginning after December 31st, 2017 and before January 1st, 2021 can be carried back 5 years. There was a technical correction to the Tax Cuts and Jobs Act, which had some ambiguous language regarding taxable years beginning after December 31st, 2017. They made that correction. The carryback rules don't apply to NOLs generated by REITs. There's special rules for life insurance companies and cert rules that were eliminated under the Tax Cuts and Jobs Act weren't restored under the CARES Act. NOLs generated in the same period cannot be carried back to offset 965 income, which was a foreign income inclusion provision, and the carrybacks related to 965N elections as well. Some taxpayers are hesitant or don't want to carry back their NOLs and therefore need to go back and elect to forego the carryback provisions. Since the carryback provisions are recently implemented, taxpayer is required to carry back their NOL 5 years and then carry it forward. Some taxpayers don't want to make that carryback, therefore they amend their 2018 returns or elect on their 2019 returns to forego that carryback. And then they're eligible to carry forward those NOLs. For taxable years beginning after December 31st, 2020, the NOL deductions generated are limited to 80% of taxable income. There's some nuance here in the calculations, but that's a little bit too nitty-gritty for this kind of conversation. So if you have any questions about the 80% NOL limitation, we can have a discussion offline. So when taxpayers are looking to carry back their NOLs, they are looking at the different variables that affect an NOL carryback with regard to deductions taken in previous years, as well as tax rates. The corporate tax rate for years prior to 2018 was 35%. The current corporate tax rate is now 21%. So corporations that have NOLs in 2018, 2019 are looking to carry back their NOL to receive 35% of every dollar carried back, compared to 21% on a carry forward. Some items that are detrimental to the NOL carryback are DPAD deductions that were taken in previous years, as well as 179 election expenses and charitable contribution deductions that would end up being carried forward if you do carry back your NOL. We're going to skip a couple slides. The next change is to the corporate tax charitable contributions. Corporations used to be able to deduct 10% of their taxable income as a charitable contribution deduction. They've increased this limit to 25%, and any excess contributions can be carried forward 5 years. They've also increased the limitation on contributions of food inventory to qualifying charities from 15% to 25% as well. The next item to talk about is a business-related provision that affects individuals. It's the 461 limitation on business losses that was implemented with the Tax Cuts and Jobs Act. With the Tax Cuts and Jobs Act, the business loss deduction for a individual would be $250,000 that filed single or head of household, and $500,000 for married filing joint. The excess of the annual limitation on those losses would be carried forward as an NOL, and those provisions applied to the calendar year 2018 through 2025. Under the CARES Act, it defers the implementation of this rule until calendar year 2021. So taxpayers are looking back at their 2018 returns to see if they did have losses in excess of $250,000 and $500,000 respectively, to see where additional losses could be applied to 2018 taxable income and to receive refund opportunities. Additionally, they remove the separate application of the limitation, similar limitation for farm losses until 2026. And then within the rules, they clarify the post-2020 limitation rules related to wages from employment, capital gains and losses from the sale of business assets, NOL deductions, and 199A deductions from qualified business income. Next item to talk about are changes to the interest expense deduction under 163J. The Tax Cuts and Jobs Act replaced the pre-2018 version of the 163J rule with a new provision. Under the old rule, 163J disallowed thinly capitalized corporations from deducting disqualified interest. Post-Tax Cuts and Jobs Act, the 163J interest expense limitation was more broadly applied to all taxpayers, and it limited taxpayers' interest expense deductions to 30% of adjusted taxable income plus business interest income and floor plan financing interest. Under the CARES Act, they increased the Section 163J limit for 2019 and 2020 to 50% of adjusted taxable income rather than 30% of adjusted taxable income. This allows taxpayers to deduct more interest expense and therefore generate more losses that can be carried back under those NOL provisions. And then they also implemented a favorable rule for 2020, which allows you to elect to use your 2019 adjusted taxable income in place of your 2020 adjusted taxable income. Here, I believe the IRS is and Congress is providing relief for those that do think that they are going to generate a loss in 2020 and therefore have a very low adjusted taxable income in 2020. There are special rules for the application of these interest expense limitations to partnerships and partners. In the case of a partnership, the increased Section 163J limit from 30 to 50% of ATI does not apply to taxable years beginning in 2019, but it does apply to taxable years beginning in 2020. In lieu of the increased limit for the taxable years beginning in 2019, CARES Act provides that in the case of any excess business interest expense allocated from a partnership for any taxable year beginning in 2019, 50% of such EBIE shall be treated as business interest, which is paid or accrued by the partner in the partner's first taxable year beginning in 2020, and which is not subject to the partner's Section 163J limit in 2020. The remaining 50% of that EBIE will be subject to the similar adjusted taxable income rules. Each partner of a partnership has the ability to apply these rules separately and doesn't have to do the same thing with their partners. So some of the benefits of these rules are tax savings in 2020 with regard to additional deductions. Items to look for are managing your financial projections and your estimated tax payments to help conserve cash throughout the year. The next item is another provision under 163J. In 2018, a lot of real estate businesses made an election to be accepted from the Section 163J rules and were bound to use longer depreciation lives. Had bonus depreciation been allowed for those companies, they may have not made the selection. So what they did was they put a provision in through a revenue procedure that allows people to revoke their 163J elections that treated them as accepted businesses so that partnerships and real estate businesses could amend their partnership returns to revoke that election. And that moves into a specific provision that is heavily impacting the rental real estate business as well as retail and restaurant businesses. It's a rule related to qualified improvement property. It corrects a glitch in the Tax Cuts and Jobs Act that made interior improvements to structures 39-year property that was not subject to bonus. Under the technical correction, it makes that same qualifying improvement property 15-year property eligible for bonus. So this is where we see a lot of taxpayers taking a look at their 2018 returns and 2019 returns if they've already filed them to see if they had a build out, an interior build out or a qualifying improvement property to see if they can take that amount as 100% bonus depreciation rather than depreciating it over 39 years. Qualified improvement property includes improvements a taxpayer makes to an interior portion of an existing building that is non-residential real property. Unfortunately, residential rental property is excluded from this provision. Examples of qualifying improvement property include installation and replacement of drywall, ceilings, interior doors, fire protection, mechanical, electrical, and plumbing. It excludes improvements that are internal structural framework, enlargements to the building, and elevators and escalators. Under the Tax Cuts and Jobs Act, taxpayers that made that real property, trade, or business election under 163J were required to depreciate that property using the ADS method, which made people depreciate the property over 40 years, and they weren't allowed to claim bonus. However, the IRS did implement procedures where you can revoke those elections. Next, we're going to talk about some partnership tax issues with regard to some of these amended returns that are going to be filed. If the partnership has extended its calendar year 2019 tax return, it can file a superseded return until September 15th of 2020. Superseding returns are treated as originally filed returns with the IRS. So if you filed an extension on March 15th to extend the due date of your tax return until September 15th, you can always file a superseding tax return to take advantage of the CARES Act. For those that are amending returns related to 2018, you need to consider whether your partnership is subject to the centralized partnership audit regime and whether you've elected out of those centralized partnership audit regime procedures. For those that are within the CPAR rules, administrative requests, adjustment requests need to be considered, since that's how a CPAR amended return would be filed. One item to note is that if you do make a administrative adjustment request, those adjustments are taken in the tax year in which you issue the adjustment to the taxpayers or partners. So if you were to issue an adjustment to a taxpayer for a 2018 return in tax year 2020, the tax impact would be picked up by that partner on their tax year 2020 tax return. I think I got a little bit ahead of myself, so here's the slide that talks about that. Now, if you're amending returns that are older than 2018, you need to consider whether you're subject to the TEFRA rules. So the open years for amendment are currently 16, 17, and 18. 16 and 17 2016 and 2017 partnership returns may be subject to TEFRA. 2018 returns may be subject to the centralized partnership audit regime. If you're not subject to TEFRA or CPAR, then the partnership amending the return provides K-1s to the partners, and the partners can go back and amend their returns for 2016, 2017, and 2018. Otherwise, if you are subject to TEFRA or CPAR, then the adjustments take place at the partnership level unless there is a push-out election. Some other items to consider are the real property, trade, or business election that we previously talked about. The IRS has issued some procedures to revoke the elections by filing amended returns. Again, you got to consider the centralized partnership audit regime procedures if you are going to amend your return. The next item to talk about is Section 163J for partnerships and the special rules attributable to partnerships that are intended to alleviate the need for partnerships to file administrative requests for already filed 2019 returns. Hopefully you filed an extension and can supersede your return so that it's treated as an originally filed return rather than making an administrative adjustment request. If you make an administrative adjustment request and you are subject to, because you're subject to the centralized partnership audit regime, then the partnership is responsible for the adjustment unless they make a push-out election. One of the items that a lot of partnerships are considering for 2019 is making a change of accounting method to claim bonus depreciation. This accelerates the benefits of capital expenditures and allows for additional deductions in the tax year. A lot of taxpayers are trying to generate net operating losses in 2018 and 2019 so that they can carry back losses into previous tax years where they can receive a tax refund related to NOL carrybacks. Lastly, we'll get into a couple of tax compliance and reporting issues. The IRS has postponed tax day. Today would usually be tax day, but the IRS has postponed that for 90 days. So income tax filings and income tax payments that would normally be due April 15th are now due July 15th. And that's pretty widespread. There's no limitation on the amount of payments that may be postponed to July 15th. The relief is provided to individuals, trusts, estates, partnerships, corporations. Interest and penalties are also postponed and begin to accrue July 16th of 2020. No extensions needed for the payment or deposits of any other type of federal tax or for the filing of any federal information returns. The IRS has also allowed Form 4466, which allows corporations that have overpaid estimated tax to apply for a quick refund. And there's specific procedures on how to do that as well. So that concludes the items I'd like to talk about today, and I'd like to open up the session to question and answer.
Hey, this is Paul. Just wanted to remind everyone that there's an opportunity to ask questions through the chat box, and I'll go ahead and moderate that in that perspective. As we open it up, I do have some questions. I know some of our small business and restaurants and whatnot and retail have gone through a period of layoffs. Through that layoff periods, because of this crisis, most of them do expect to rehire later on as the economy picks up. Do you have any advice or clarifications or anything that you can provide on a tax perspective for companies who are in that situation?
Sure. So a lot of companies in the restaurant space are trying to obtain these PPP loans. And those PPP loans are based on average payroll costs over the trailing 12 months or prior calendar year. The second part of that is the loan forgiveness provisions, where the taxpayers that we serve are more focused now on how to maximize forgiveness of those loans, and the function of that forgiveness is a numerator, which is full-time equivalents employees for the period for which the 8-week period for which the loan starts, and then the denominator is full-time equivalent employees over an 8-week period starting in the same quarter of the previous year or the first 8 weeks of this year. And so a lot of taxpayers are managing their full-time equivalents over the period of which they have this PPP loan to maximize their forgiveness. Outside of that, a lot of taxpayers are rehiring as demand picks up and should be cognizant of the credits available to them as they rehire employees.
Okay, thank you. No, it's good to be able to know that. I know a lot of the people who have this situation, it really helps on this aspect of tax and either deferring or even more so how it benefits them. Just another question, as new legislation is coming up, well, in a sense, the next wave of relief, do you foresee anything that is in the pipeline for legislation that could be beneficial to small business or corporations or even individuals?
Sure. There's a lot of new legislation out there about raising more money for the PPP program. It's being consistently talked about, but there's nothing concrete out there yet. The Federal Reserve did open a new program called the Main Street Lending Program, which is lending to small and medium-sized businesses between up to $1 million, at the lowest $1 million, up to $25 million of loans. So the Federal Reserve is also issuing some relief.
Okay. No, it's good that we can see, and hopefully that's the lookout as we update the website and even more so the news as we get news. How does this also affect the transition of people coming back to the workforce? Do you see any on that perspective?
It's hard to say because a lot of communities are still shut down. A lot of companies are trying to start work remotely. And those that are not equipped to work remotely are trying to transition to that point.
Okay. I just wanted to see about that perspective. Another question is, I know because of this extension for filing for 2019, do you see any benefits of being able to take advantage of that and extending this aspect of filing a little bit later so that you can see what it's upcoming for how it benefits in order to file 2019's tax return? Or do you suggest just go ahead and file it and then later on amend it, anything that needs to be amended?
There's no one blanket answer to that question. If you're due a refund, you can always file a return using estimated figures and put a disclosure in your return that it is an estimate to receive a refund and then refile later. Now, my advice would be to file later as your accountant digests the provisions within the CARES Act and how it impacts you. And I would actively discuss this with your CPA to see where you can get additional deductions to pay less taxes in 2019 and hopefully inject more capital into your business because you didn't have as much taxes due.
Okay, it's good to know. I guess I'm going to just have two more last questions because I'm just trying to open up the chat forum, but I also understand people have more individual private questions that they can. Could you provide your contact information on a slide on that? And then the second thing is, could you tell me, people who've just came on to the call later on, can you tell me about BDO and what you guys do and what kind of services you guys provide?
Sure. Yes, I can provide my contact information. BDO is a international accounting firm. Here in the U.S., we have offices across the country. We're either like the 5th or the 6th largest in the U.S. We provide audit, advisory, and tax services. Me specifically, I provide tax services to private businesses and individuals.
Okay, good. And then do you have any things that you've seen, because I know y'all been helping a lot of companies with the PPP and this other idle loan that you have, and have you heard any feedback of what people are doing and how the government is responding in their application? Just as a general overview of what you've been seeing from your observation.
Sure. A lot of clients are applying for the PPP loans. I have a couple of clients that have already received their PPP checks. The process is different for every client, depending on which bank they're using. Different banks are requiring more or less information depending on their risk appetite. Some banks are asking for the kitchen sink, while others are more lenient in what they're requesting from their clients to give out these loans.
No, and it's good to know. We did have a question from the chat box here. Is there a sliding scale for the SBA loan forgiveness? Example, if the net revenue loss during the specific time is 10% versus 50%, we'll get different amounts of loan forgiveness.
Sure. The forgiveness isn't based on net revenue loss. The forgiveness is based on a ratio of full-time equivalents during the 8-week period after you get the loan versus the 8-week period, and there's an option on the denominator where you can choose a period that's in 2019 or the first 8 weeks of 2020. And so you first start by looking at that ratio compared to whether you use the loan for the appropriate costs. So the first part of it is, did you use the loan for payroll, rents, utilities, etc.? And then secondarily, what's your ratio on numerator to denominator of full-time equivalents?
Okay. Just a clarification, not clarification, but could you also provide information how they can get in contact with you after this presentation?
Sure. Would you like me to provide that in the chat box?
Yes, or you can generate a slide. If not, we can definitely put this when we post our, this PowerPoint and this presentation will be posted online. In that perspective, we can also put that information there. Justin can definitely put that information in the chat box at this current time so that you as participant, if you have further questions, you can contact him directly. So as I'm going to close out and just being able to just close out this webinar, we first want to thank BDO and Justin Lin for putting this webinar together. Again, we'll be posting this presentation and resources that we talked on our website with the link provided in this particular session. I'm going to go ahead and change slides so that it will allow you to see the website. We have this website here that we built for the chamber and resources. Oops, sorry, this is the wrong one. Media resources. You can go on our website. I'm sorry, this is a different website link, but you can go on our website. There's a business coronavirus 19 link that has resources, and we'll go ahead and post our webinar up there. Oh, sorry. There's one more question that came through a chat box as I'm trying to close out. Do you foresee any property tax relief in Texas?
First and foremost, I mainly deal with income taxes, so property taxes is not my forte, nor do I deal with it on a day-to-day basis. But I have not seen any guidance from the local counties on property tax relief. What I do imagine, though, is that you can use the economic situation to lower your property tax values when you go to protests.
Okay. No, thank you. Thank you. So just kind of wrapping up again, thank you, Justin and BDO for this particular webinar. I just want to let you know, we have, as a chamber, been putting a lot of different events. One of it is by this gracious aspect where BDO is able to help navigate some of the questions that is related to tax and how to save money. I know a lot of it is individual questions and individual scenarios, and that's why Justin has provided his contact information in the chat box. And you can definitely contact him directly there to answer your personal questions. In that note, I also want to let you know, with this link that you see on this particular slide, it's related to our ACC industry meetups that we happen daily at 4 p.m. It's kind of like our version of happy hours with industry focus for our members to talk about resources and basically offer encouragement towards these hard times. So you can find out by going to the website or this link here and find an industry and sign up. For those who are not members yet, we actually offered a 2-month free trial membership to experience some of the resources that we're providing here, just like this webinar and some of the other webinars that we've been posting, which you can also find on YouTube. Please check out our website for more information and up-to-date information of what we're doing. We have our newsletters, and if you're not on it, please sign up on our website to stay connected. Also, you can follow us on social media with the links provided on the top portion of our website, www.asianchamber-hou.org. Again, thank you for spending this afternoon with us. Please reach out to the Chamber if you have any questions. We're happy to help. Hope to see you at future webinars. This concludes today's webinar, and thank you, Justin, and thank you, BDO. We will be ending this presentation shortly. Thank you.